So far in this series, we've taken full custody of our crypto assets in a personal blockchain account. We've swapped tokens on a decentralized exchange and cut our trading fees by 99% versus Coinbase. We've borrowed against our portfolio at about 4% interest, no forms, no credit checks, and no bank. And we've put that borrowed capital into a concentrated liquidity position that pays us cash flow every single day. But there's one problem that every liquidity provider eventually runs into. The moment price escapes your range, the cash flow stops and you're stuck holding the underperforming token. So what do? In this video, I'm going to explain exactly what happens to your position, and I'll give you some strategies for how to handle it. Let's get into it. All right, so before I speak about anything else, I've pulled up this wallet in our Overseas DeFi portfolio tracker, and I just want to remind us what we started back on June 3rd. So this is the liquidity position that I opened up. We borrowed $60 from our portfolio, and then we deployed that $60 into this liquidity position. I deposited about $20 in USDC and about $40 in wrapped Ethereum into the position. Before I do anything else, I'm going to go ahead and collect the fees on this position. It's been almost 3 weeks, but let's go ahead and start by collecting the fees. So here is the position on Uniswap. I'll click into it and we see I've earned $1.03 in fees. So I'll go ahead and collect those. And you can see I'll be collecting about 53 cents in Ethereum and about 50 cents in USDC. That's how it goes. It's generally going to be about 50-50 in terms of the two tokens that you're providing liquidity for and what you're earning in the swap fees as the position and the price is in your range. And when I collect these fees, these tokens are coming directly to my wallet. The liquidity position is still in place, but the fees will come out to my private account. Now, we've recently upgraded our app with the new fee tracker. This gives you the detailed information about your liquidity positions and the history of those positions. So we can see it's updated with the $1.03 in fees that I just collected. If I expand this out, we can see the deposit. And then here, about 19 days later, I finally collected the fees. The APR on that was about 33%. That's a pretty good yield, but it's a lot lower than what we normally achieve on these liquidity positions. And now I'll take a look at the chart and explain why the fee collection was kind of low on this position. And it's because the price escaped my range. So here's the position that I opened on June 3rd. And I marked this line here. This is about where the price of ETH was when I opened the position. And remember, I deposited about 20 USDC down in this part and about $40 worth of wrapped Ethereum up in this part of the position. Remember, a liquidity position is always doing the opposite of what the traders are doing. So if traders are mostly buying ETH, the price is going to go up and my liquidity position will sell ETH to the traders all the way up to the top of my range. If on the other hand, traders are mostly selling ETH, the price goes down and my position is spending its USDC to buy ETH from the traders. If we drag this over, we can see that price eventually broke out the bottom of my range and stayed down there in the following days. We had a bit of a bounce last week, I believe. So the price did come back up within range. It's generating fees. So this entire part of the price action occurred outside of my range and there was no cash flow being generated while the price was outside of the range. Now, at the moment, the price is completely below the bottom of the range. So all of the USDC that used to be in the position, that has all been spent buying ETH from the traders, and now the position has been fully converted into 100% ETH. You can see that on Uniswap, we're holding 100% ETH and 0% USDC. So as I said in the open, our position has been converted into the underperforming token. ETH underperformed the dollar, it went down versus the dollar, and so our position is fully converted into into ETH. Of course, the value is a little bit lower because as we're buying ETH inside the position, the price keeps going down. So that bag of ETH at this point, 0.033 ETH, is now only worth about $57 as opposed to the $60 that we put in there. The analogy I like to use for providing liquidity is it's like you're fishing with a net. And initially you cast your net where you think the price is going to trade. And if the price stays within your net, you're collecting fees. But when the fish swim somewhere else, they're no longer in your net, you're no longer catching that price action, you stop generating the fees. So the idea is to move your net to somewhere else where it will once again resume capturing the price action and generating fees. When you're deciding where to put your new range, treat it just like we did when we opened this position. You want to look at the recent price action, find the pivot points, and make a decision as to where you think the price action is going to trade over the next days and weeks. We don't have to be perfect at predicting the price action, but the more price action that we can capture with our range, the more fees we're going to generate. So now I'm going to give you two strategies with respect to where you can put your new range. The first strategy is what we call a snuggle. Here you can see the new range. I've snuggled it lower, close to the price without overlapping the price like that. So I can snuggle my range lower, close to the price without going over. The advantage of this strategy is that no rebalancing, i.e. no trading, needs to take place. The old position we've just discussed, it's already 100% ETH, and the new position will also be 100% ETH because the price is still fully below the range. So I don't have to rebalance any of my ETH from the old position to USDC in the new position. The disadvantage of this strategy is I'm still not in range. So I didn't have to place a trade, but I also am not collecting any fees unless the price bounces higher and goes back into my new range. The other strategy is what we call a rebalance. If my new range extends below the current price, I'm going to need to deposit USDC into this new position, right? Because if traders keep selling, the price keeps going down, I need USDC down here to buy ETH from the traders. So in this case, I have to rebalance from 100% ETH to maybe 75% ETH and 25% USDC. That is a trade. I literally have to sell some of my ETH for USDC at this current price. Now, I never know in advance the outcome of that trade. I just know that I would have to sell ETH at this lower price. If the price bounces higher from there, I just sold the bottom and I could have just waited, or I could have snuggled and not have to sell ETH down at that low price. If the price keeps dropping and goes even lower, then that's a good outcome because at least I sold some of the ETH at this higher price before the price went lower. When you're deciding between a snuggle adjustment or a rebalance, you want to think about what the price is likely to do from here. If you think the price is pretty low and it's going to keep trending higher, then I wouldn't rebalance. I wouldn't sell part of my liquidity position at this low price. I would maybe snuggle the range down, getting it close to the current price, and then allow that prediction to play out. Hopefully the price bounces and keeps trending higher. You start earning fees again. If I believe that the price is going to drop further from here, then I probably want to rebalance the position, sell some ETH at this relatively high price, and then let that prediction come true where my position is buying back the ETH at lower and lower prices. In a nutshell, when you're changing your range, it is a trading decision and it will have a nice outcome or a poor outcome depending on what you did and where the price goes after you made that trading decision. Again, we don't have to be master day traders to do this. We're still going to have great yield, fantastic results, results, even if we don't make the best decisions with respect to moving our range. With all of that being said, I'm going to go ahead and use a protocol called Krystal to rebalance my range lower. I'll probably end up leaving it about the same width. This former range was about $300 wide, so my new range, I'll go ahead and also make it about $300 wide. Now remember, you don't want to do a Google search for your different crypto and DeFi protocols. Just go into Rabby, click the settings, and search dApps. I'll type in the name of the protocol, Krystal, and go to the official website. Once you're on Krystal and your wallet is connected, go ahead and click into the profile. Because your wallet is connected and that Uniswap NFT is in your wallet, this protocol can see the position. What we're going to do is come over into this and we are going to rebalance the position. Now that's just the name of the function here on Krystal. If you wanted to do the snuggle adjustment, you can still click on the rebalance button and do that. It just depends on where you set your new range. So this is what happens behind the scenes on Krystal. And what's happening when you're moving your range and casting your net in a different location, what's actually happening is the old position is being closed out. All the capital is being withdrawn from the old NFT. The tokens are rebalanced, and then those tokens are deposited into the new position with a new NFT and your new price range. So my new position, I'd like it to be from about 1655 up to 1965 or so. So I'll type that in, 1655 and 1965, enter. I'm going to drop this down by one tick, and the top of our range, we'll put that at 1958. This shows us the new liquidity position. Again, the old position is 100% wrapped ETH. The new position is going to be about 72% wrapped ETH and 28% USDC. So Krystal is going to make that swap for us. It's actually going to do three things. Number one, it's going to withdraw the capital out of the old position. Number two, it'll do a swap where it swaps some of that wrapped ETH for USDC. And number three, it will deposit the new liquidity position. Now there is a 5 or 6 cent fee to do this. You can do this the manual way and not pay the fee, or you can do this the easy way on Krystal and just go ahead and eat the little platform fee that it charges. So let's choose the easy route here. Go ahead and confirm this new position. It's going to take the old NFT out of our wallet, and then it's going to mint a brand new NFT and send it back to our wallet. Usually when it's doing that rebalancing and the swapping, there's usually some leftovers. Those get refunded to your wallet. I'm getting a little bit of a warning from Rabby. It's saying that I've never transacted before on this smart contract. That's fine. I literally have never used this wallet with Krystal to do this, but I trust Krystal, not a problem. So I'll ignore that, sign and confirm, and success. The transaction has taken place. We can look at the new position on Krystal. There it is. Still has roughly the same value. We can see our new range and the current breakdown. The NFT is sitting in my wallet, so I can actually look at this position on Uniswap as well. There it is. And I'm going to go ahead and update my chart. So the range is 1655.79 up to 1958.68. On TradingView, if you select your rectangle and click on this settings button, it will let you put the exact numbers in there. 1958.68, 1655.79. Perfect. So there's my new position on the chart, and I can just take a look at this chart anytime I want and see how I'm doing. Is the price still in range generating fees, or has it escaped again? The last part here is I just refreshed the screen here in our new fee tracker, and notice how it has the new move range event in here. So what we're doing with these liquidity positions, when you use Krystal or Revert to manage these positions and you use it to move the range up and down the chart, fee tracker is keeping track of those different positions as one contiguous position. So it's almost like thinking about a liquidity position as like a high yield savings account, where it's going to keep track of the running equity, what you deposited or withdrew from the account or the position, position. And just because you moved the range somewhere else doesn't mean it's still not that same high yield bank account. That's how we're tracking it now in the fee tracker. And we can see that when I rebalance the position, I got a wallet refund of about 1 cent. And so it's keeping track of the money I have invested at risk in this liquidity position, as well as the average yield. And it'll keep track of the value of the position as well. Your job as a liquidity provider is to capture as much of the price action as you can and keep generating those daily fees. Just like a fisherman casts his net where he thinks the fish are, you set up your range where you think the price action is going to be. But if the price moves, you have to adjust. Don't worry that you have to be perfect and catch every single price move. Just do your best and the yields will be great. I promise you that. If you get stuck or you want some help, make sure to tune into my live streams every Tuesday at 6 p.m. Eastern. Click the bell to turn on notifications so you don't miss out. Thanks for watching. I hope it helps. I'll see you next time.